Good afternoon and welcome to the Pabrai Wagons Fund Semi-Annual Investor Call. At this time, all lines are now in listen-only mode. Following the opening remarks, we will conduct a question and answer session, and if at any time during this call you require immediate assistance, please press star zero for the operator. I would now like to turn the conference over to Mr. Kan Tran, Fund Distribution Manager at the Pabrai Wagons Fund. Thank you. Please go ahead.
Thank you. Good afternoon. Welcome again to the Pabrai Wagons Fund Semi-Annual Investor Call. We're glad you could join us. Before we begin, let's start with the usual disclosures. Mutual fund investing involves risk, including the potential loss of principal. The fund is non-diversified, meaning it may focus on its assets in fewer individual holdings than a diversified fund. Therefore, the fund is more exposed to individual stock volatility than a diversified fund. The fund may invest in small and medium capitalization companies, which involve additional risks such as limited liquidity and greater volatility than the larger capitalization companies. The fund is new with no operating history, and there could be no assurance that the fund will grow to or maintain an economically viable size. Opinion expressed or subject to change are not intended to be forecast as future events, a guarantee of future results, nor investment advice. Fund holdings and allocation are subject to change at any time and should not be considered a recommendation to buy or sell any security. On the call today, we have our portfolio manager, Mohnish Pabrai, our senior vice president, our senior analyst, Fahad Mismar, and our vice president, Chaya Valatrilla. Now, I'd like to hand the call over to Mohnish Pabrai.
Thanks, Khan, and welcome to our first semi-annual investor call of the Pabrai Wagons Fund. I am excited that all of you have joined us as partners and investors on this journey. Before we get to your questions, which are my favorite part, I'd first like to give you a bit of background on the fund and how it is positioned from here. The Pabrai Wagons Fund was launched on September 29, 2023 and completed its first quarter on December 31st, 2023. The fund seeks to invest in durable, growing businesses with robust reinvestment engines and aligned high-integrity teams. We seek businesses that we would be comfortable owning for a very long time. And we want to acquire fractions of these businesses when they are being offered at meaningful discounts to their underlying intrinsic value. From time to time, the fund will also invest in special situations like merger arbitrage, opportunities where we believe the odds of success weigh heavily in our favor. Our principal focus in the first 3 months was to deploy the fund's capital in the highest conviction investments that we believe will deliver the best returns. To this end, we have been very pleased with the portfolio that we've put together. As of December 31st, 2023, the fund was invested in a collection of 20 exceptional businesses in the United States, Turkey, Canada, and Europe. The fund investments reflect 4 core allocations, which account for 76% of the portfolio as of December 31st, 2023. These were, first, the Turkish workhorses like Coca-Cola İçecek, which is a global Coke bottler based in Turkey and operates in 11 countries. Anadolu Efes, which is Turkey's biggest beer brand. And TAV Airports, which is a Turkish airport operator that operates airports in 8 countries. Second bucket is U.S. coal, which includes thermal and metallurgical coal plays like Consol Energy, Alpha Metallurgical Resources, Warrior Met Coal, and Arch Resources. Third is U.S. car dealerships, including Asbury Automotive, Lithia Motors, and AutoNation. And fourth is North American and European tech that includes Microsoft, Amazon, Constellation Software, Topicus, and Tiny. A common theme amongst the businesses in all 4 groups is the exceptionally high quality of their underlying franchises. In addition, the first 3 buckets, which is Turkey, coal, and car dealerships, represent corners of the market that are misunderstood. The misunderstood status of these industries has resulted in these businesses being mispriced by the market. We love businesses that are hated and unloved, and I'm excited to circle the wagons around these three buckets. Although our track record since inception is only 5 months old, and this is a very short period of time to make any intelligent assessments of performance, we are off to a good start. Here are some of our performance numbers since inception. From September 29, 2023 through February 29, 2024, the retail class was up 18.33%, and the institutional class was up 18.45% versus the S&P, which was up 19.63%. We're just slightly behind the S&P there. In 2024, year-to-date through February 29, 2024, the retail class is up 9.74%, and the institutional class is up 9.75%, ahead of the S&P 500, which is up 7.11%. You can find standardized performance numbers, including quarterly performance, on our website, wagonsfund.com. The S&P 500's recent performance is significantly above its long-term average, driven by huge gains in the so-called Magnificent Seven of NVIDIA, Meta, Apple, Alphabet, Microsoft, Amazon, and Tesla. These seven make up approximately 29% of the index today, so the S&P 500's future performance is highly dependent on them. We believe all seven businesses are exceptional, but they appear to be fully priced or, in some cases, overpriced. In contrast, the Wagons Funds owns just two of these seven, which is Microsoft and Amazon, and together these two make up approximately 7% of the fund. Despite this, the fund is doing better so far this year than the S&P. This is a very short period of time, but we believe our ship is pointed in the right direction. Our mission is to beat the S&P 500 over the long term. I'm excited about the Wagon Fund's future. Our investment philosophy is rooted in the belief that exceptional investment performance is usually the product of only a few great investments held for a very long time. The trick is not only to find the great investments, but also not sell them. Evoking the defensive maneuver of American pioneers in the 1800s, the fund will circle the wagons around its highest conviction holdings, which we believe will have the highest potential for investment returns. I hope we are smart enough to hold on to the businesses in our portfolio today for a very long time. Now I'll pass the floor over to Fahad Mismar to take us through our pre-submitted questions. Fahad?
Thanks, Mohnish, and thanks to all investors who pre-submitted their questions. The first question is about the fund's exposure to coal. The coal industry is out of favor and presents an opportunity. Why are we specifically invested in Alpha Metallurgical Resources, Arch Resources, Consol Energy, and Warrior Met Coal? How long do you see the coal industry continuing to outperform and continuing to make a positive contribution to the fund?
Thank you, Fahad. Yeah, that's a good question. We don't so much view things as in favor or out of favor. What we're trying to do is basically look at the intrinsic value of businesses versus where they are priced by Mr. Market. And just for illustrative purposes, these are not, real numbers of any company, but just to illustrate kind of how we think, is if we had a business that was going to be around for, let's say, 40 or 50 years, and at the end of that 40 or 50 years, it would cease to exist with zero terminal value. And let's say that over that 50-year period, on average, the business would generate about $1 billion a year in cash flow. It might be $500 million some years and $2 billion some year and $200 million some year, but let's say on average, it ends up being 40 or 50 billion over that time. If such a business were available for purchase at 3, 4, 5 billion, we would like to back up the truck. And we don't want to specifically discuss the names in the portfolio beyond that because we are continuing to buy them every day as assets come in. We prefer to buy them at lower prices rather than higher prices. These businesses, most of them are buying back their shares. We prefer that they buy back these shares at lower prices rather than higher prices. And if they were ever a no-brainer, I would think these coal names are a no-brainer. Next question, Fahad.
Thanks, Mohnish. The next question is about our positions in Turkey. Why Anadolu Efes, and why not Reysas for the fund?
With regard to your question on specific positions not in the fund, as we have disclosed in the fund's document, including its statements of additional information, in addition to the Pabrai Wagons Fund, I manage various private funds. I am restricted by SEC rules from discussing any information on the private funds in this type of forum, so I won't go there. But what I will say is that for regulatory purposes in various countries that we invest in, typically our ownership in a particular company is aggregated across all the accounts that I manage. So when it comes to smaller companies, they may have reached the maximum ownership limits long ago with the accounts that existed at the time. And so the Wagons Fund may be limited from investing in them today. We may also have a situation where if I look at a business like Reysas, for example, in aggregate across various funds, we own around a third of the business. And the promoters of Reysas may not be very comfortable with our ownership going beyond that. And regarding Anadolu Efes, Anadolu Efes is the dominant beer brand in Turkey, in Russia, in Ukraine, and a bunch of other countries. When we look at the prospects of that business and the future cash flows of that business versus where it's priced, we like the risk reward, which is why we invested in it. Next question, Fahad.
Thanks, Mohnish. The next question is, I'm curious about the strategy behind investing in large corporations like Microsoft and Amazon with relatively small stakes. Given their size, a 3 to 5x over the next 10 to 20 years seems plausible. Yet with a modest 3% allocation, their overall impact on the portfolio seems like it'll be limited. Could you share your rationale behind these decisions?
Yeah, that's a good question. Mutual fund investing rules restrict us in terms of how large positions can be and how diversified the fund has to be. And these are really good rules, I think, because these funds can be bought by Joe Public, and I think they're good rules to protect Joe Public. So we do not have open discretion to willy-nilly make any position, any size we want. And within those constraints, I think we did what we could with Microsoft and Amazon. Next question, Fahad.
The next question is on circling the wagons. The question is, the concept of circling the wagons implies an intent to hold those stocks found in the center of the circle for a long period. In this context, what does long mean to you? I ask this because 3 of our current investment buckets are centered on currently, quote-unquote, out-of-favor sectors. 2 of those buckets thermal coal and car dealerships are inevitably going to see their top line stagnate in the future due to the inherent forthcoming changes in their industries. If those stocks are held for too long, they may be in danger of being melted ice cubes. So on these types of bets, how do you characterize the idea of a quote-unquote long holding period?
Yeah, that's a great question. We are not convinced that these are melting ice cubes. I think there's a distorted view of car dealerships, and there's a distorted view that car dealerships are going away. From all the work we've done, we don't think they're going away. We don't think the parts and service is going away, even in a world where it's 100% EVs. And we don't think there's a world with 100% EVs for decades. So we don't see the car dealerships in any sort of decline in any sort of 10-year or longer period. So we are very comfortable circling the wagons around those, especially given the valuations, and some of them are buying back shares and so on. Thermal coal, we have only one position in thermal coal, which is CONSOL Energy. Most of its coal is exported, and a large portion of that exported coal, it is not used to generate power. Thermal coal has many uses. Many of those uses are industrial uses, and many of those industrial uses have no alternative or no good alternative. So CONSOL has some of the highest quality coal assets, thermal coal assets anywhere in the world. They have an exceptional management team, really impressive. They forward sell at least a year to 18 months in advance their production with bands around what the minimum and maximum prices that they will receive. So, for example, in 2024, we already know before 2024 started what would be the low-end and high-end cash flows that CONSOL would generate. We also already know in 2025, almost 30-40% or more of their production has already been forward sold. And before this year is over, most of 2025 will be forward sold. CONSOL has no meaningful debt. They're following a very simple philosophy of taking all cash flows that are not required by the business and buying back their shares. Given where the shares trade and given the stability of cash flows, and given the duration of those assets, and given the fact that these are not melting ice cubes when the usage is not in power plants, we are very comfortable with CONSOL. Next question.
Thanks, Mohnish. The next question is, was the Spirit Airline bet based solely on the potential merger with JetBlue? Do you still see something in Spirit now that it looks like the merger has been called off?
Yes, that's a good question. It was a merger arbitrage bet. It looked at the time that we made the bet that the odds were in our favor that the merger would go through. After the merger was called off, the Spirit shares went down quite a bit, and we were well below what we paid for them. And of course, the thesis was no longer valid. What we did is we switched the Spirit stock into a position in Spirit bonds. So we basically just swapped that investment with the bonds. In any case, the bet was a relatively small bet, I think at around 4% of total fund assets. And now, since we haven't added to that bet in a while and the assets have gone up, it represents a very small portion of the pie. Next question.
The next question is, why did you decide to start a mutual fund, and how did you decide on the fee structure? Can you explain the fee in layman's terms?
Yeah, sure. Well, we've been approached for many decades by lots and lots of people who wanted to invest with us, but they couldn't because of the nature of the private funds and the high minimums and so on. So I was looking for a more democratic vehicle, and that's why we decided to go with a mutual fund. The fee structure is pretty straightforward. We have two asset classes in the fund, a retail class and an institutional class. The retail class has a all-in fee of 1.25% a year, and the institutional class has a fee of approximately 1% a year. The way we decided on these fees was just looking at, where the industry was at and what our costs were and what was reasonable. The reality with mutual funds is that it's a very regulated regime with a lot of expenses, a lot of regulatory compliance expenses. And pretty much all of the fee we collect would be going towards those costs, not really coming to us in terms of any types of profits, if you will, until the funds have some level of scale. The funds need to get to something close to north of 150 or 200 million before there are meaningful fees that will flow to the investment advisor. And so we decided on the fee structure because we thought it was a fair structure and we thought it could be a win-win for everyone. Next question, Fahad.
Next question is, how should an investor with a long-term view, like a 10-year horizon, be prepared for the impact on the Wagons Fund when the market enters bear territory or if there's a correction?
Yeah, that's a great question. Our fortunes are very much tied to the top dozen or 15 bets that we made. And these bets are, like we've described earlier, in a few buckets. So if we end up being right in most of those or a good majority of those, then I think we will do fine. We may go down and markets go down, but in the long run, basically, the funds will perform based on the underlying businesses. Next question.
Thanks, Mohnish. And now we will open up the floor to a few questions from the audience for the remaining time on the call. I will hand it over to our operator.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Should you have a question, please press star followed by the 1 on your telephone keypad. You will hear a prompt that your hand has been raised, and should you wish to cancel a request, please press star followed by the 2. I would like to advise everyone to have a limit of 1 question each. If you're using a speakerphone, please leave the handset before pressing any keys. Your first question comes from the line of Harry Wu. Please go ahead.
Hi, Mohnish. This is Harry. Thank you so much for hosting the call, and thank you for starting this fund. As a retail investor, I've been following you for a while, and so very grateful for the opportunity. My question would be regarding the top 2 positions. There's Anadolu EFS, and there's also Coca-Cola Isotech. And I guess the question I have is what is your thought process surrounding both of these? With Anadolu, I feel like you get both. You get Coca-Cola and you get this very, cheap beer business along with it. So that seems like a more value-oriented play, in isolation. So could you just maybe give us your thought process surrounding owning both of these stocks, and how you kind of see them as different?
Yeah, that's a very good question. You're absolutely right that Anadolu FS owns 50% of Coca-Cola ISEC. And so if we owned just Anadolu FS, we would have exposure to Coca-Cola ISEC. But that exposure would be a little bit diluted because it wouldn't be a full bet on Coca-Cola ISEC. Both these businesses have truly exceptional characteristics in terms of quality of the business. Not only is the business quality very high, the family that owns a controlling stake in these businesses, or a large stake in these businesses, has one of the most pristine reputations in Turkey. They have many global partnerships with world-class companies around the world. And these companies, when they chose their partners in Turkey, went through a pretty rigorous diligence process. So, for example, all the McDonald's franchises in Turkey are owned by this family. It's not a listed business. It's a private business owned by the family, but McDonald's basically went with them. To give you another example of a deal that took place recently is Anadolu FS, their largest business on the beer side is their Russia beer business. And the Russia beer business is a 50-50 joint venture with Am InBev, which is part of, the Budweiser people, 3G Capital and all of that. And a number of American companies in Russia have a lot of pressure to divest all their holdings. And Am InBev needed to divest their stake in the Russia business. So just to give you an example, Heineken sold their Russia operations for $1 to exit the business. What happened recently is that Am InBev sold the 50% of the business they owned to Anadolu FS. There was no money that changed hands, and the ownership of the 50% went to Anadolu FS with an undisclosed future payout to Am InBev over the next few years based on how that business performs. There was no disclosures given on what that formula is or what those payments would be over time. The only thing that Am InBev disclosed is that they estimate that their portion of the Russia business had a value of around $1.2 billion or so. Now, if you just take a step back and think about it, a seller sold a business to a buyer with no money collected, money to be collected in the future. The seller would only do that if they had absolute faith in the reputation and ethics of the buyer, which is the case here. And they basically left it into the future on that thing. Now, the other thing to note about this particular deal was that this deal took almost a year or 18 months to work out. And I think what happened in the negotiation, this is just my speculation. I have no information from inside the company or any of that. My speculation is that the way Anadolu FS and the owners of Anadolu FS run their affairs is that they are interested in long-term relationships and long-term partnerships with these players. So they would not have wanted to negotiate this by trying to squeeze the last dime out of AmInBev. They would have realized that AmInBev is in a distressed situation, and they would have, in my opinion, acted very honorably with AmInBev, saying, yes, we understand you have to sell. We understand that logically we are the buyer. We understand that you're being very gracious by not doing through an auction, and we will treat you well. And AmInBev accepted that because the two companies have had a long relationship together. And AmInBev owns 20% of Anadolu FS, and they sit on the board. So they have some upside on the other side as well. So it's not like it's a one-sided transaction. In all the different businesses we have seen, now just to give you, I will give you two more anecdotes, which will then maybe hopefully explain to you why we wanted so much exposure to these two businesses. So on the Coca-Cola side, the Coca-Cola ISEC side, they do bottling for Coke in a number of countries. One of the countries which ISEC did not do the bottling was Uzbekistan. And in Uzbekistan, the bottler of Uzbekistan, the Coke bottler of Uzbekistan, was a 50-50 joint venture between the Coca-Cola company and the Uzbek government. The Uzbek government basically inherited that state from Soviet times, and they ran that plant and that business, or those plants and business, like the former Soviet Union. So basically the way that business was run was that the government had a monopoly on the bottling. They were the only authorized bottler of Coke in the country. And they sold everything at the factory gate for cash. So they did not have a truck network. They did not advertise in any way. Coke might advertise, but they didn't put any money into advertising or anything. And they sold a very small sliver of Coke products, like 3 or 4 products. And basically, if you wanted Coke products, you showed up at the factory gate with cash, and you picked up the product. Coke was very unhappy with this situation. They had been trying for a very long time to try to get the Uzbek government to divest that stake so they could get a better bottler in place. And the Uzbek government was not interested. Finally, the Uzbek government contacted them and said, we have decided to sell the stake, but we're not going to sell it to you. We're going to sell it to the highest bidder, because that is in the best interest of the Uzbek citizens. And Coke tried to tell them that it was very important for them to have a good relationship with the bottler and to be able to select the bottler. But the Uzbek government didn't care. So what the Coca-Cola company did, and the Coca-Cola company owns 20% of Coca-Cola ISEC, and they sit on that board, they told Coca-Cola ISEC to please bid in that auction for the business in Uzbekistan and to pay whatever price was necessary to win that auction, regardless of the multiple. And Coca-Cola ISEC told them that, we have a business to run. We can't be paying any price. So Coke said, listen, we will sell you our half at a very low price and make it work for you. But please do not let that bottler go into any other hands. So the Coca-Cola company also only made this approach to one bottler out of all the bottlers they have globally, which was Coca-Cola ISEC. So for whatever reason, they picked them. And we know what the reason they picked them, because it's a very high-quality team and a high-quality operation. Coca-Cola ISEC won that bid at a very high multiple, something like 25 times EBITDA or something. Coke sold them their portion at a very low multiple, single-digit EBITDA, I think. But even when you blended the two together, it was a very rich multiple. And the analysts who follow Coca-Cola ISIC were upset with the company for paying so much for the business. In the first year that Coca-Cola ISIC ran the bottler in Uzbekistan, they quadrupled the net income. And they were asked, what did you do? What did you do to quadruple the income? And they said, quite frankly, we didn't do much. All we did is we bought a few trucks. We painted those trucks red. We went into town. We shook the hands of the various merchants. We started to give them some refrigerators with, glass fronts so they could put these Coke products in. And that's all we've done so far. We haven't broadened the product line out. We haven't updated the dilapidated old plant yet. We've got a long ways to go. And the Uzbekistan bottling operation now looks like the deal of the century. And they still haven't fully flexed. And so what I'm trying to say is that the Coca-Cola company handed this to them on a platter. They handed it to them because they were very, very happy with the way Coca-Cola ISIC ran the other bottling operations. Recently, this happened just a few weeks ago, the Coca-Cola company gave Coca-Cola ISIC half the country of Bangladesh, the bottling rights of half the country. Bangladesh actually has a higher per capita GDP than India. It's a pretty big market. It's a big deal that they got it. They didn't pay much for it. They were, again, not too happy. It was Coca-Cola themselves who were doing the bad bottling. And I don't think Coca-Cola is a great bottler. They're great at selling concentrate. And I think that we will see it play out in Bangladesh, maybe not to the extreme extent that we saw it play out in Uzbekistan, but I would expect Bangladesh volumes to go up. And just to continue a little further, Coca-Cola has a published list of problem bottling regions and problem bottlers, which is visible on their website. There's a big problem that they have in India. A number of the bottlers in India are significantly underperforming Pepsi, and Coke is unhappy. I don't know if Coca-Cola ISIC will ever get any part of India or not, but the odds of them getting some part of India is above zero, maybe significantly above zero. So the way we look at it is that it's now, Coca-Cola ISIC is now the third largest bottler in the world for the Coca-Cola company. I think it's an exceptional leadership team. It's obviously a great brand, great partnership with Coke. And with just having the Anadolu Efes position and getting the Coke ownership through that, did not, from my perspective, give us the exposure that we were looking for. I think this is a very unusual business which will be doing well for many, many decades. And we wanted to circle the wagons around both of these businesses. So sorry for that long answer, but that is why 1/5 of the fund's assets are sitting in these two beautiful businesses. Next question.
Thanks, Mohnish. That's awesome.
Thank you. And your next question comes from the line of Claudia Aragon. Please go ahead.
Hello, Mohnish. Thank you very much for the opportunity. Fascinating anecdotes about Anadolu. Reminds me of anecdotes you told in the past about how BMW would always be calling Rain Industries. My question is regarding the positions in Amazon and Microsoft. One of the three principles of the fund is don't pay prices for great businesses. And I've heard you talk about optical, businesses that are optically overvalued. And I just wanted to ask about your thought process about generally, if you can talk about the specific positions, companies that have sort of nosebleed PE multiples like Amazon and Microsoft and others in the Mag 7, and how you think about them. Do you go through a process similar to what Adam Cecil talks about, and redoing the financial statements in your mind to strip out the growth expense and to realize what the just the raw earning power of the business is if they weren't plowing so much and reinvesting so much into growth? Or is it more about what Warren Buffett talks about and, being able to look out 10, 15 years into the future, and how reliable is that, the growth and, over the long term? That's the question in essence.
Yeah, well, that's a good question. I would just say that when you look at the allocations we have to Amazon and Microsoft, it should be obvious that they are relatively low conviction ideas in the broad scheme of things. So I would say that it would be relatively low on the list when we go from top to bottom in terms of highest to lowest conviction. Having said that, these two businesses are truly exceptional businesses. In the case of Amazon, one really cannot look at a trailing PE multiple to get any sort of an idea of what that business is worth. They are always investing so much ahead of the curve that that would be, give you a very different picture of reality versus what is actually going on. And in the case of Microsoft, I would say, if you excuse my language, they kind of have like diarrhea, in the sense that revenue in many cases is equal to net income. It just goes straight from revenue to net income, but almost nothing in the middle. So it's a very exceptional business in the sense that I think Microsoft is one of those almost indestructible franchises because of the recurring nature of their business and how deeply entrenched they are and how more entrenched they're getting. So when we moved to software as a service, they went through a massive increase in earnings and cash flows. I mean, I just remember myself that if I would buy a, copy of Outlook or Office or something, I really wasn't interested in upgrading or going to the next version, even 5 or 7 years after I bought it. With the current situation, I just don't have a choice. I have to ante up every year. And what I'm anting up every year is a multiple of what I used to ante up. So it became, a great business going towards like a truly exceptional business. They've executed very well so far on the AI side, and I think that Satya is a very gifted leader. So I did not get the view, I did not arrive at a conclusion that these businesses were fully priced or overpriced. I also didn't arrive at the conclusion that they were screaming bargains, but I thought the truth lied somewhere in the middle. And so we took a relatively small position, and I think that if things show up on the radar that are more compelling, we will see whether it makes sense to switch out of them or not. But that's where we are with these two businesses. Next question.
Thank you. And your next question comes from the line of Jason Mullenkamp. Please go ahead.
Thank you, Mohnish, for this Q&A session. Really appreciate it. I'm going to tie together two related questions really quickly. Any specific reasons why the Wagons Fund was launched as a traditional mutual fund rather than an ETF? And then secondly, from public info, it's clear that there's substantial overlap between the Wagons Fund in your pre-existing funds, yet there's clear distinctions in the holdings. Beyond the position limit drivers you discussed earlier, can you discuss the philosophical drivers that are driving, the quite similar but yet meaningful differences? Thank you.
Yeah. I think we went with the mutual fund structure because by and large, I think a lot of ETFs are more simplistic. They're more on autopilot, much more index type products. This is very much a actively managed fund. It's not really a index type product. And so it just, to us, it just made sense. And the other thing is that we weren't necessarily looking, one of the advantages of ETFs is that you can, trade them all day long. And we weren't really looking for that type of a demographic in terms of the investors. In fact, that's why we have a redemption fee if people sell within 90 days of purchasing. We wanted to attract a certain type of investor. And I think in terms of the overlap between, again, like I said, I'm restricted on what I can talk about in the private funds with all the SEC rules, but I would say the private funds generally don't have really any restrictions on how big a position can be or how many positions we have to have or any of those. So I think by definition, the Wagons Fund looks very different from the other funds that we have. But I really, like I said, because of all these rules and laws, I really can't talk much about it. But it's a really different vehicle. I think you should focus on it as itself and kind of take it from there. Next question.
Thank you. And your next question comes from the line of Ryan Maxwell. Please go ahead.
Hi, Mohnish. Thanks for taking the question here. I understand and really appreciate the thesis around the car dealership plays as a whole. I'm curious if you can talk at all about your thought process behind selecting a couple of specific dealerships in the U.S. instead of maybe doing a more broad basket bet, incorporating other companies like Lithia, Penske, so on. Appreciate your thoughts there. Thanks.
Yeah, that's a good question. If we stick to U.S. dealerships, there are not that many dealerships in the United States that are publicly traded of any size that we could invest in. Penske, for example, is a really good operation. I like Roger Penske a lot. They have a great truck business, and I think it's a great place. But it's a little bit different from the Asburys and Lithias of the world from the perspective of buybacks. So Penske really is not in a position to do buybacks because 50% is owned by Roger Penske, and another 20% is owned by Mitsui, which is one of the 5 bets Warren made. And so, 70% is kind of closely held, and so it's not really focused on buybacks, and the multiple it trades at is a little more than some of these other players. So when we looked at, I would say the most impressive of the group that we looked at was Asbury. I would say that the others, someone like Lithia is a little different animal, but I think they've got a very good capital allocation engine. So I would say in terms of capital allocation, I would put Asbury and Lithia up there. In terms of quality of operations, Group 1 is exceptional, more Texas focused and so on. But I think if you took a dart and I think threw them at the top 5, including Penske. So what I mean is Asbury, Lithia, Group 1, AutoNation, and Penske, and you bought a basket, I don't think you would go wrong with that. I think that basket is likely to work out quite well. Next question.
Thank you. And your next question comes from the line of Eugene Secchi. Please go ahead.
Hi, Mohnish. Thank you for taking my question. My question is longer term, and it has to do with timing when you buy stocks. In Pulak Prasad's book, What I Learned About Investing from Darwin, which is a book that you mentioned in one of your YouTube talks, he talks about buying a lot of stocks during the downturn in 2008, 2009, and COVID. He could do this because he structured it this way, being able to draw funds when he wanted. When the market came down, he asked his existing investors to add more. Pulak talks about this as being one, buying in uncertain and depressed times as one of the drivers for his fund success. But as a mutual fund, do you have the ability to buy when times are depressed, or do you have to kind of buy when the funds come in, which, retail investors historically, they buy when times are good, and that's generally not when the markets are depressed? Thank you.
Yeah, that's a great question. I don't think we have any kind of a regulatory mandate that we have to be fully invested. So we do have flexibility there. At the same time, I'm not a market timer. So if we see opportunities that it makes sense to put our capital in, like I would say that, if we had inflows into the funds, we're very comfortable adding to our dealerships and adding to our coal bets and adding to Anadolu FS and so on. So I think when we have a degree of comfort on those, we'll proceed. If we didn't have a degree of comfort on those, we could close the funds or we could build the cash, etc. We haven't had to go down those routes so far. But those tools are available to us. Next question.
Thank you. And your last question comes from the line of Harry Wu. Please go ahead.
Hey, thanks for taking another question. This kind of goes back to one of your earlier points, Mohnish, about the size of the fund, and then what point it becomes sort of more profitable for the advisor. And we hear a lot about just scaling up funds from Buffett and Munger in terms of at some point it becomes harder to kind of provide value over the index returns. Is there a certain point at which you say this fund is too large? I know it's early days for the fund, but just thinking long term, is there a point at which it becomes too big where you say it's more difficult now because of the size to deliver the type of performance you're expecting to?
Absolutely, there is a direct correlation, inverse correlation between size and performance. And I would not be excited about running a fund that has a very low probability of beating the index. And I think beating the index becomes hard if you become really large. So we would play it by ear. We would just look at the opportunity set and how we were doing versus the size and what we had in the mix. And if it started to get to the point where we were having difficulties, we can seal off inflows, and that's perfectly fine.
Great. Okay, cool. Thanks so much.
And thank you very much to everyone for participating. I really enjoyed this first call, and I hope you enjoyed the session as well.
Thank you. Ladies and gentlemen, that does conclude our conference for today. Thank you all for participating. You may all disconnect.